The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Platform banking's role in the growth of fintech can hardly be understated, with companies including Monzo, N26, Revolut, Chime, Acorns, Betterment, MoneyLion, and many, many more starting or expanding on top of regulated third-party banking providers. Similarly, the promise of embedded finance, where non-bank brands and consumer experiences deliver banking and other financial services directly to customers, is predicated on the ability of platform infrastructure. Platform banking offerings are clearly fit for purpose, right? Far from it. In today's conversation, Aman and I are joined by David Jarvis, founder of Griffin, a seed-stage platform bank in London, to discuss the current state of platform banking, the shortcomings of existing offerings, and the role of the next generation of platform banks in delivering the future of finance. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome David Jarvis. David Jarvis, welcome to Rebank.
Thank you. It is a pleasure to be here.
All right, so this is great. I'm glad we can connect on the air. We've known each other for a while now, and I've had pretty good visibility into what you guys are doing, and I'm very excited about it. So glad to be able to discuss it publicly. Aman Guy's here also, who not only brings interesting perspective and experience around this specific topic, but infrastructure, fintech infrastructure more broadly, which I know he has some views about, which we'll pull in. To kick off, David, maybe you can tell us about Griffin and why you're doing it.
Sure. So Griffin was set up in the wake of my experience at a company called Standard Treasury, which was a couple of years ago, back in 2014, 2015, a Y Combinator and Index Ventures-backed API banking startup in the US, which was really focused on providing what you would now think of as open banking products to US commercial banks. And the lesson that we sort of took from that experience, which unfortunately was not successful, we were a little bit too early to market, was A, that there was going to be a huge opportunity in the API banking space, B, that existing banks would not be well set up to capitalize on it, and C, that the US might not be the right jurisdiction in which to do it. Accent, obviously, I'm like you, American. We're recording this from London today. In the wake of the sort of Standard Treasury experience, I started paying a lot of attention to what the PRA and FCA were doing here in the UK about making it easier to establish new sort of technology-driven, innovative banks. And then a couple of years later, when Monzo was authorized, I said, okay, cool, this is really worth a closer look. And with Griffin, essentially what we're looking to do is to provide banking services and infrastructure, both from a banking products perspective, but also from a technology product perspective to money service businesses, which could include firms in the sort of capital market space, so brokerages, could include payments firms, sort of merchant acquisition, could include like the online lending community, as well as more technology-driven and innovative companies that are looking to offer strategic products that are maybe financial services products, but that you wouldn't think of as traditionally financial services companies. So Google with like a checking account, or more traditional organizations that also have these sort of strategic products like, I don't know, Mercedes-Benz running a leasing program, or BP running a prepaid card program. And the sort of common theme here is that all of these firms are not banks and need a banking partner to work with. And the existing partners that they could work with, so your sort of major clearing banks, et cetera, have really pulled back from this market and never really had the technical infrastructure to offer what these companies really need going forward. And so with Griffin, what we're looking to do is to sort of build this API-driven bank where we've built our own core banking system. We're currently going through the authorization process with the PRA and FCA here. And once we hopefully are authorized, fingers crossed, we want to be that sort of ideal partner for other companies to bring their financial services products to market.
Yeah. All right. So I love this. I've spent a lot of time looking at the space, working in the space, most recently running a banking partner selection process for a new U.S. retail-focused proposition. So, neobank model, build a technology in the front end, work with a licensed bank on the back end to deliver banking products. There are lots of companies who are using that model in the U.S. right now. Everyone from from an Acorns to a Betterment to a MoneyLions, Monzos, N26s, Revoluts. The list goes on. It was interesting how you said 2014, 15, you guys were seeing this opportunity. This opportunity feels as ripe and as untapped now as it did back then. I mean, despite the scale that some of these fintechs are getting, despite the number of fintechs that are now using this model, it's just not easy. Like, the back-end infrastructure isn't there. People are getting so excited about platform banking, about banking as a service, about AWS of Banking. We are in the IBM mainframe era. We're not in the AWS of Banking era. And you're building the AWS of banking. I do think it's probably a bit different in Europe. A couple of companies come to mind, Railsbank, Clearbank, which I think skew toward the payment side of the world as opposed to the more capital-intensive banking side of the world. So I wonder, David, if you could make that distinction between what some of these more payments-focused platform providers do versus what you're looking to do.
Yeah, sure. I'll touch on Railsbank just quickly first. So Railsbank in the EU and the UK does not have a banking license in spite of the name. So they operate with what's called an electronic money license, which gives them the ability to sort of provide payments and money transmission services. I'm using that term like sort of broadly, but doesn't have the ability to offer credit. And critically, that means like also doesn't get sort of deposit insurance, which then ties into a bunch of other things. So they're sort of not allowed to work with certain companies that, for instance, share their regulatory designation. So they can't actually hold money for other electronic money institutions. They can't hold money for payments institutions. And they can't really offer credit, or they can, but it's coming sort of off of the company's balance sheet. They don't have a funding source for that. Clearbank is much closer to a direct competitor to us. So they have a full banking license. They are a new clearing bank here in the UK. And you're right that they're less focused on sort of credit opportunities, but I do think that in many ways they and we have honed in on a very specific sort of market set, and I think they're pretty sophisticated, honestly. I mean, their products are very targeted to the types of companies that we are also going after. And the way we differentiate ourselves from them is that we're really looking to do this in more of a batteries included way. So I like the sort of AWS for banking analogy. For us, the North Star is Stripe, who really took a lot of compliance work and then just automated it and pulled it completely behind the scenes. And that's where I think a lot of the sort of magic happens. And so for us, a lot of what we want to do is to take, sort of identify complexity and infrastructure at every possible level, and compliance is a really big part of this. And then to say, okay, to companies that want to build on our platform, okay, what if we handle that for you, right? You don't necessarily want to have to acquire all of this expertise. You don't want to have to build all of this infrastructure. If we build it, or if we offer it for you, which we're already going to do to dozens of other financial services companies, which is why you can sort of trust us and rely on us, we can get you to market quickly. We can do this at a scale that you probably can't. And that's a much stronger value proposition.
What do you think of Solaris, David?
So Solaris is very much in a similar model to us. I think Solaris made one massive strategic blunder extremely early on, which was not to build their own core banking system. So they use a pretty old system called Pass, and that has led to quite a few growing pains. And I don't think that they are at a point yet where they want to rip the Band-Aid off either, which again, I think is a strategic error. Product-wise, what the sort of customer experience is, very similar. The challenge is that I don't see their pain points getting any better until they really take control of their destiny.
We're in a really interesting time in infrastructure banking in particular. Mark Andreessen coined the term "software is eating the world." We're very much in a period where you could say APIs are now eating the world. And essentially, that is driving this adoption of banking infrastructure. If you think about it, a lot of the older institutions have not been API first companies. They've basically had to remodel their existing infrastructure and build out APIs for third-party providers with poor customer experience for developers to develop further products on. Take Wirecard, for example. That's a behemoth in the card issuing space, very valuable company, but was not an API-first company. And so you have companies like Marqeta, for instance, coming along and being API first, and David's company as well. So we're in a really interesting time where companies are figuring out it has to be developer first, at the same time offering their clients the flexibility and ease of moving into one product or the other, building on top of the other in a compliant fashion. And that's really what's driving infrastructure adoption in banking.
Yeah. David, you said that Stripe is more your North Star than someone like a Clearbank or AWS. At least simplistically, one of the advantages of Stripe is that it's like self-serve, plug and play, like developer friendly, just go in and do it. Is that part of your strategy also? Is the point to make this as easy to consume, hands off from your guys' standpoint as possible?
Yeah, absolutely. I mean, I think that's a huge part of the focus for us, because one of the places where we see the most severe pain point is at sort of initial setup and onboarding. And so even for our more sort of technology-driven competitors in the market, you're still looking at like a 6-month onboarding process, which if you're a startup and you have either not raised capital or you've done your first round, like your investors don't want to hear that it's going to take you 6 months to get like onboarded with the bank, and that's not when your actual product is going to launch. You're then looking at like 9 months, a year. It's a lot of time, and time is money, right? Because you need to staff up in that time. So one of the big things that we want to do is just to say, okay, we're going to make it possible for you to self-serve into a sandbox right away. You can get integrated with the API. You can sort of test things. You can build a sort of demo app. And then when you want access to live payment rails, yes, we're going to have to get a little bit of due diligence on you, but it's not going to have to be as invasive because we're offering this sort of integrated compliance model. So one of the reasons why onboarding is so slow with our competitors is they really want to understand what your systems and controls are. They want to know how you're managing your money laundering risk, your financial crime risk. By offering that in a sort of batteries included fashion, we can say, actually, like we know how you're handling this because you're using our rails, and so therefore all we need to know is who you are and how you plan on making money and who else owns this company, which is, just way, way, way less of a hassle, and is frankly like a lot easier information to acquire.
So I'm interested. You said before that the U.S. wasn't the right market for this, so you came here to do it. Why is that? I mean, based on my own personal experience, the U.S. would be a fantastic market for this.
This is often the case. It is a great market, but you can't have it. So what you see right now is you see a lot of state licensed banks going after this market. And the challenge is that the state bank licenses that they hold limit their ability to do business across the country. So what you really want is what's called a federal charter. People also worship these old Utah charters called industrial loan companies, but you can't get those anymore because all the regulators hate them. So people like find out about these and then get incredibly excited, but we'll leave that aside. The challenge with getting a federal charter is that you have multiple regulators you need to get through in the U.S., and they're not all super friendly. So in the wake of the financial crisis, the OCC and other U.S. regulators took a lesson from the crisis, which basically was, okay, look, we've got, 10,000 like federally chartered banks or 10,000 banks across the U.S. We don't really need any more. And every time we offer a new banking license to someone, they seem to have a lot of problems. Why don't we just stop granting these? And if someone wants to have a federal charter, they can show up with, $100 million and buy one. Like if they're rich enough to buy a federally chartered bank, they probably know what they're doing. It's basically been the U.S. approach. By contrast, in the UK, very different lesson from the financial crisis. They sort of looked at the consolidation and said actually we only have 4 banks and one of them almost went down and we had to bail it out and it was hugely expensive. And we don't have a lot of small banks. So we should actually, and P.S., we've been regulating these banks quite aggressively for a very long time. And that doesn't seem to have solved the problem. So actually, we probably need to eat away at the consolidation here because we have huge systemic risk. And so in the UK, very pro-competition. They were like, okay, great, we need to get new entrants in here because nothing else has worked. In the US, they're like, you know what? Like, if you want to do this so badly, show up with $100 million. Me, personally, I don't have access to $100 million, so buying a federally chartered bank was not an option. And at the moment, getting a new one is so hard it veers on impossible. The only one, I guess, Grasshopper Bank got one recently, and that was the first one that I had heard of in quite a while. And I think Vero either has one or is close to getting one. But in both of those cases, I think they started out as state chartered banks first. So if you're thinking about how to get to a federally chartered bank, your two options are, like, do not apply cold. That is a total dead end. You can build a state bank first, which will take you years and also be very expensive, and then upgrade to a federally chartered bank, maybe. Or you can do what we're doing, which is to go to the UK, which is the most ripe market for financial services and fintech in the world. And then once we're set up here and we have established ourselves and hopefully are in a position of profitability, then we would look to re-enter the US market. There's a term for sort of like foreign national banks moving in on a federal license, but that's basically the plan for us.
Love it. Aman, I'm interested in your kind of general thinking at the moment around infrastructure as a fintech theme and what you're seeing. That's interesting.
From the 2010s to, I would say, half a decade later, 2015, there was this compulsive drive to compete with existing financial institutions. And the only way to do that was to build from the very ground up exactly what they were going through, which involved getting a license, having the capital adequacy requirements. And once, I would say, people figured out that there are not going to be a lot of winners in this space, the model shifted a little bit in terms of, I would say, a more collaborative approach. So it's interesting, kind of banking hasn't gone through this, but insurance went through this fairly quickly, right? Just to make an analogy here, the insurtech space, there are a lot of kind of consumer types of businesses, but not a lot of them are addressing the pure capacity issue of insurance, which is reinsurance and that marketplace. In banking, for 5, 6, 7 years, people started to address that and have now realized that it's a much better approach longer term to build collaborative infrastructure whereby you are providing not only a particular market with access to a financial service, but have that ability to scale without the requirements necessarily to build a bank yourself, right? So taking deposits, right? Having the ability to take deposits is not an easy feat to achieve. But if you are a company that can very quickly provide that scale to another company, that's what venture capital's like, which is scalability of businesses, right? So we've seen the shift, I think, more so pronounced in the last kind of 2 or 3 years towards more infrastructure type solutions where you are building collaborative. I keep using the word collaborative because I think it's a really important component in the space we're in right now. Is we're not necessarily disrupting industries from a consumer standpoint. We're disrupting it from an infrastructure standpoint. And I think that's what's really interesting about this space is you're giving companies all around the world the access to infrastructure they would have to have raised hundreds and millions of dollars for. And that's phenomenal.
David, I probably should have led with this, but for context for the audience, what stage are you guys at right now?
We are currently 10 people. We did a pre-seed round with Seed Camp in 2018 and then did a £3 million seed round last year. And hopefully that should be good for a while. Fundraising is not the most fun part of running a startup.
Okay, so on that point, like as I said at the very beginning, I totally get the opportunity and I get what you're doing. Why do you think that fundraising wasn't easier? Why weren't people throwing capital at this?
So I think one is for some of the reasons that Aman just touched on, which is that there are only going to be so many winners, and it requires a lot of capital to get there. The other one is time to market. Going through the authorization process with the PRA and FCA, I want to be clear, it's not really about them. It's that the process itself requires a tremendous amount of work that is very time consuming. And it's like the sort of the Navy SEALs thing. Slow is smooth and smooth is fast. Like what that means is you don't want to go quickly and make mistakes, because then it'll take you even longer. So you have to sort of be slow and deliberate and make sure you're not making any errors. And that's the fastest way you can get there, but it's still time consuming. And so investors would look at this and say like, okay, wow, you're talking about like maybe 2 years to market, like 2 years before launch, right? Like that is rough if I am not in, year one of my 10-year fund. And even still, right, then if it's year one of their 10-year fund, they're like, do we want to make like this aggressive of a bet as our like first bet that we have to market to our LPs? It's tough, right? You run into a lot of issues with sort of fund dynamics. And so for us, actually, a lot of the round came from private individuals who have just a much, much longer time cycle and have the ability to be patient capital. And we've also been lucky to have a few funds in there that I think knew about the space already and didn't need any education and were just looking to make a bet. And when they saw us, they were like, yes, like that is the thing I've been looking for, done.
This space is not Facebook's mantra of move fast and break things. Let's be honest about this, right? So you cannot have a MVP type solution out there for deposit takers. If something breaks, that's catastrophic. So you need to get it right pretty much the first time. And maybe that's a little bit about what scares investors. They have not necessarily backed a lot of these companies before, these types of companies before. Take capital markets, for instance. Funnily enough, there's not been a lot of innovation in capital markets, core capital markets infrastructure, right? So debt is still being issued the same way. Last week's episode, we talked about equity. Same systems. Bloomberg still has as much market share as you could possibly imagine. And the reason is people are not willing to take infrastructure bets quite yet in this virtuous circle of if something goes wrong with a $5 billion debt trade, that's catastrophic. So there is a little bit of patience required in this space, more than you would see in a typical software company even. So that's been one of the reasons I think investors have been a little bit hesitant. The winner takes all mentality, we've spoken about it before, David, is interesting in this space. And maybe it has to do with being geo-specific to a particular region, UK, US, Germany, rest of Europe, is at what scale can a company get to whereby it becomes obvious that if I'm trying to build a solution here, I need to work with them, right? So this happened in the payment processing space. There were a handful of payment providers, and it took a while before the Adyens and the Stripes could get in there, right? It took Adyen 10 years to really get to where they were today with people who've built these systems at WorldPay before, for instance. So it's a little bit, I would say, mentality driven as well. But look, it all comes down to market timing. I think that's one thing we as investors don't want to take a risk on, is we don't want to have market risk. I think you want to have technology risk, which is fine. You want to bet on the team to deliver a great technological experience. What you don't want to, I keep using the word bet on, you don't want to take risk on whether this is going to be adopted right now. And when things take longer to get through the pipeline, people start questioning, is the market there for this right now? And so that's kind of been, I would say, the hesitancy around this space in the last couple of years. But I think that will change as regulators get more comfortable with propositions that enable companies to deliver a diverse set of financial products.
I want to sort of expand on that, actually, because I think I want to take what you're saying and go back to something you said earlier, which is that it requires a lot of upfront investment. Once you have it, you have this thing that has required this investment that other people want, right? And so you're right, there is that kind of market risk when you're going into it. But what we have actually seen is, especially with the challengers of the last 5 years here in the UK, we have seen a certain amount of market pivoting and market flexibility. I mean, Starling, yes, I think probably mostly think of as like a consumer bank, but they're also in business, they're also in platform banking. Like they do a bunch of their own like payment services provision, like they do a bunch of things that people don't necessarily pay attention to. Clearbank similarly has like evolved its product suite quite considerably, and so and seems to now have some traction there. Like I think once there are only going to be so many of these entities, and they are expensive and they are hard to set up. But once you have it, you do have quite a bit of flexibility in how you use that power that you've earned. And so I think, one of the things that's going to be really interesting over the next 5 years is going to be looking at the current wave of challengers who entered the market with one strong brand focus and how they leverage that regulatory asset in other markets through partnerships.
I think what will be interesting from a regulator standpoint, and you probably know this better than I do, is how can you dissect some of these pieces without, let's say, requiring that much capital. If the regulator can start getting better at understanding what these propositions are, I think these capital requirements start becoming dissected into smaller pieces and becomes better for the startup. So take the insurance world again. I really like this analogy because 5 years back, it was very hard to become an MGA, a managing general agent. Today, it costs $500,000. Anyone can become an MGA. And that's because the regulator was able to really dissect what an MGA does and whose capital they are risking. And I think similarly in banking, when you start attacking payment services or deposits, I think these require different levels of capital. And if you can dissect those, then people will start getting traction quicker and will be able to go back to the markets to raise more money for their bigger vision of building this platform out. Trying to raise $100 million on a blank company is very, very difficult. It's very difficult. So they really need to start getting to dissecting.
David, I know you thought a lot about the best route to market. Like, was it launch of the banking license, raise money to fund that? Was it start with kind of a regulatory light approach, prove traction, get a product out there, and you obviously opted for the banking license approach. Can you talk a bit about that thought process?
Yeah, so one of the challenges that we face is that as a infrastructure bank, we are banking other regulated financial institutions, and there are regulations that govern what class of regulatory institution you have to be in order to serve them with the types of products and services we wanted to offer. So, one of the things that Monzo did that was super smart, obviously, was to launch early, become an EMI, get that prepaid card out into market, and then graduate to a banking license. That made a ton of sense. We don't really have the same option. We can become an EMI, but then, again, we can't work with these payments firms. We can't work with other EMIs. We can't work with anyone who wants to offer an ISA product, which is a large part of the sort of capital market space. And if we're thinking about, raising money and then the bank being the sort of ultimate destination, one of the fears that I had was that we would just be stuck in a funding trap. Like we would raise what we needed to get an EMI license, and then we would bring something to market that wasn't that compelling, and then we would need to raise more money to go and become a bank, and we would turn to investors and they would go, yeah, but what you have now is not that interesting, right? And there would be no retort to that. It'd be like, oh, but the thing we're going to build is more interesting, but it still basically costs us the same amount of money that it was going to cost us from the beginning. So I think, I don't know, I maybe in keeping with my American heritage, I have an extraordinarily high risk tolerance. I would just rather do the very, very hard thing right out the gate, because then when it's done, I have that. Once it's done, it's done.
So the Stripes and some of these other transaction-based API companies take a clip on payments or whatever they're doing. Banks traditionally, banks that are required to hold significant amounts of capital, leverage their balance sheet. and it's taking deposits, it's lending, it's net interest margin. Is that a component of your guys' plan?
It is, but not necessarily for the reasons that you would think. So it is because in the UK, being a bank requires you to lend. The definition of being a deposit-taking institution means taking deposits with an eye to lending. And so if you don't lend, you cannot be a bank. And so conveniently for us, in the course of our sort of market research, we were interviewing all of these financial technology companies about the struggles that they had finding a banking partner. One of the common themes that came out of that was like a surprising number of these firms are very thinly capitalized, good for VCs, but they really struggle with working capital requirements. And so, and no bank will lend to them, right? Because they're tiny, scrappy, thinly capitalized fintech startups, right? And so one of the things that we think is a really interesting opportunity on that side is to say, okay, cool, you're building on top of our platform. We have insight into all of your transactional activity, all of your account balance activity. We basically know like as much information as we could possibly know about how creditworthy you are. No one else wants to touch you, but we are super interested actually in trying to help you out with your working capital. So I think that's going to be a super interesting space for us. And there are a ton of different opportunities there. One of the sort of awesome things is that it almost defies categorization. We just see so many different ways that we can provide help there. And I think in particular, it's great to be able to say like, okay, cool, we're building this sort of platform bank where these firms generally have a very tough time finding banking partners, but then to be able to offer something else where they also essentially cannot get funding, right? So the alternative for this type of debt capital is really debt funds right now. Like no banks are going to touch the space. And so they're looking at a cost of capital. It's like 10% at least, because the debt funds are raising money from banks and then layering their own margin on top of that and then offering it at quite high rates. We think being able to offer that at like actual bank rates competitively in a sort of data-driven way is a really, really fascinating opportunity.
This is a really interesting problem because if you look at any fintech startup consumer-facing in the last decade or so, fundamentally what hasn't changed is the only way they make money is lending. Okay, you can offer a couple of premium accounts and so on, but they need to lend. And the first resort, as we as equity investors see this, is they go out to a bunch of debt providers and try and get terms. And the terms that David was mentioning are spot on. At 10%, it really starts eating into your margins, which effectively means that if you're not charging the customer at least 30-35%, your business model doesn't work. And so to be able to scale the lending side, particularly on capital required or debt required to be able to lend, will be phenomenal. A lot of people, I think, would benefit, and this wave of, I think, consumer fintechs not making money, opening the door for them to being able to monetize their base in a scalable way is, I think, the future of fintech banking, so to speak.
Excellent. Well, I think that's a perfect place to end as the wheels start to turn in my mind. I'm sure David will have no trouble in the future raising money from a VC who's backed a bunch of these thinly capitalized fintech startups who sees the opportunity to partner with Griffin to access credit for their own portfolio companies. But no, David, I'm a huge fan of your work and look forward to seeing where all this goes. I think you're onto something.
Thank you, Will, for having me and for all of the excellent counsel and advice you've provided about your personal experience going through this as well.
All right. David Jarvis, thank you very much for joining us today.
It's been a pleasure.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.